Good morning. Marc Ostwald from ADM Investor Services International with some thoughts on markets at the start of the year, which sort of tag on to the last video of last year. I think the way I would depict this is we are in a moment where we contrast with last year by the glass being half full, whereas last year it was seen as being half empty, even though the macro backdrop is actually pretty much the same sort of thing. First chart is the S&P 500. A relentless rally, as one can see, since beginning of October, apart from that very minor correction that we had at the beginning of December. And one might actually, on the one hand, one might say, well, that's not surprising given a lessening in US-China trade tensions. On the other hand, one might also point to the US-Iran tensions, even though we've had a little bit of relief from those ostensibly towards the end of the week. If we move then on to have a look at Europe, we then sort of also notice this absolutely colossal rally that we've seen since the middle of August in the Euro Stoxx Bank Index. 28% is really quite remarkable for a sector which is seen as being very uncompetitive, which is seen facing many headwinds, above all from negative interest rate policy at the ECB, and yet we seem to think that this is a very good sector to invest in, which starts to point to some factors like TINA, there is no alternative, and obviously hopes that with a better global economic environment, we might actually see some steepening in government bond yield curves, which should help bank earnings. But I think the headwinds which are there for Europe remain nevertheless, and that steepening of curves won't be enough to compensate for that. The third chart today is very much in that sort of vein. Really, it's highlighting how investment-grade corporate bond spreads have continued to tighten. It's not been the most enormous rally that we've seen, but I think really what it underlines is we are at a stage where, whether we're talking about government bond yields, whether we're talking about corporate bond yields, and that's at pretty much any level that we like to see, given that we've also this week seen a huge inflow into leveraged loan ETFs of about $490 million, there is a huge reach for risk. So our big question now is, are we basically making this up? Are we right to be justified? Are there, within all of this, things which say, well, that this optimism which we're seeing in corporate bond spreads, the optimism that we're seeing in the S&P 500 and the Euro Stoxx Bank Index and many other equity indices, are they reflected elsewhere? And so I come to my final two charts. So first of all, before I go through the LME chart, the LME copper chart, I would obviously mention the oil price, which obviously saw a very big spike at the beginning of this week on the back of those US-Iran tensions, but in the meantime has given back pretty much all of its rally that we had following the OPEC decision to cut production. LME copper. If we are going into a better environment for the global economy, then this really should be doing better than just trending sideways. And finally, my final chart is the CBOT corn chart. Now, this chart should actually be seeing a lot of benefit from US-China trade tensions lessening and Chinese increased imports of US agricultural imports. No such luck. We're still looking at a glut scenario. So there is a bit of discombobulation out there, i.e. a disconnect between what's going on with equities and bonds, and on the other hand, commodity markets, which don't seem to be telling us such an optimistic story on the global economy.